It's 2021, and wow, what a year was 2020. And if there's one financial lesson that we all learned, it's the importance and the power of having an emergency savings account. So in this video, we'll take a look at why a Roth IRA needs to be part of not only your retirement portfolio, but also your overall emergency savings. And at the end of the video, we'll break down the top 3 mistakes to avoid. That way, you don't get any unwanted surprises from the IRS. Now, to be completely honest with you, I've made some of these mistakes myself, so take it from me, this is a section you definitely don't want to miss. So with that said, let's get to it. So before we jump into what's new for 2021, here's a quick refresher on IRAs in general. So what is an IRA and who exactly can open one? Contrary to what you may have heard, IRA actually stands for Individual Retirement Arrangement. Now that arrangement can either be in the form of an annuity or a personal savings account that gives you tax advantages for setting money aside for retirement. And we'll touch on those tax advantages later, but unlike a regular savings account where your money just sits there and you accrue some interest, with an IRA personal savings account, you can actually invest your money in stocks, bonds, mutual funds, and unlike a 401k, you can actually invest in individual stocks and bonds. For example, you can invest in Apple, Tesla, Netflix, or you can even trade options. You can't do that in a 401k, and you can't do that with a savings account. Now, when it comes to IRA personal savings accounts, there are actually 2 types. With a traditional IRA, contributions are tax deductible depending on your income level, and contributions are typically made with pre-tax income. And when we say pre-tax income, what we mean is before you get your paycheck and taxes are taken out, some of that money actually gets sent over to your IRA before taxes have been taken out from your total paycheck. Now, the catch is when you retire and you start pulling money out of that account, that IRA, both the earnings and your original contributions are going to be taxed. Now, anyone with earned income can actually open up a traditional IRA, including teenagers. And with the Roth IRA, contributions are actually made after tax. After tax meaning by the time you get your final paycheck deposited to your bank account, taxes have already been taken out. So then you can divert some of that cash over to a Roth IRA. Now during retirement, when you start to pull money out of that Roth IRA account, your earnings and your original contributions will be tax-free as long as that IRA account has been open for 5 years or more. In addition to that, before retirement, if you want, you can actually pull out some of your original contributions at any time, for any reason, tax and penalty free. So you can already see the Roth IRA gives you some additional flexibilities that are greater than a traditional IRA. However, there are some income limits. Now at this point, you're probably asking yourself, what's considered earned income in the eyes of the IRS? Well, in a nutshell, as long as you're working for the money, whether you're working for an employer or working for yourself, it qualifies as earned income. But if the money comes from investments in real estate, stocks, bonds, things of that nature, it wouldn't qualify as earned income, which would make you eligible to contribute to an IRA, whether it's a traditional or Roth IRA. So when it comes to who can open up an IRA or who can contribute to one, you may have noticed it when I mentioned it earlier, but there are income limits. So if you're not married and your adjusted gross income is less than $139,000 per year, you are eligible to contribute to a Roth IRA. But if your income is more than $139,000 per year, unfortunately, per the IRS rules, you are not eligible to contribute to a Roth IRA. Now, if you're a high income earner and you really want to contribute to a Roth IRA, there is a secret loophole in the IRS tax code that allows you to do just that. Now, if you'd like for me to make a video on that topic, just drop me a comment below with the words how to contribute to a Roth IRA if I make too much. Now, unlike your 401k, which you get through your employer, IRAs aren't through your employer. And to open up one, you would need to sign up with a company like Fidelity.com, Vanguard.com, Charles Schwab, or an insurance company like Northwestern Mutual if you'd like to have an annuity IRA. And generally speaking, you can open up an IRA with banks, brokerage firms, insurance companies, and sometimes even with a mutual fund, you can open up an IRA. How much can I contribute to an IRA? For 2021, the contribution limits for a traditional IRA and a Roth IRA are the same, $6,000 total. Total meaning that if you have both a traditional IRA and a Roth IRA, your yearly contribution is limited to a maximum of $6,000, regardless of how you split that $6,000 between your traditional and your Roth IRA. Now, there are two reasons why you would want to open up a Roth IRA instead of the traditional IRA. Number one, to retain access to your original contributions just in case of emergency. And number two, to avoid taxes during retirement, even if taxes go up or even if you're in a higher income bracket during retirement. The ability to retain access to your original contributions yet protect your gains from taxes is the number one reason why a Roth IRA needs to be part of your emergency savings plan. In comparison, if you had your money in a regular savings account or a regular brokerage account, you'd have to pay taxes every single year on all of your gains, whether it's gains from interest, dividends, or just increases in stock price. And let's face it, how many people have more than 8 months of savings put aside? And if you lost your job during the start of the COVID crisis, your savings would be long gone by now. Now, if you had a Roth IRA, at least you'd be able to pull out your original contributions penalty-free, and hopefully that, along with unemployment, would help you get by until you land another job. And now for the top 3 mistakes to avoid when it comes to Roth IRAs. And coming in at number 1 at the top of the list is pulling out money too early. Now, yes, we talked about having a Roth IRA as a backup to emergency savings, but that backup was really as a last resort. And make no mistake about it, having a Roth IRA is not a substitute for having an emergency savings account. If you need to pull out of your Roth IRA, remember, you can only pull out your original contributions since the account was open. If you pull out anything more than that, you will get hit with a hefty tax penalty of 10% from the IRS. And number 2, forgetting about the 5-year rule. Now, if you're close to retirement, this is something you definitely need to pay attention to. Now, in order to qualify for the tax exemption on your gains when you withdraw them during retirement, your original contribution must have been made at least 5 years or more in the past. Otherwise, your withdrawal of the gains don't qualify for tax exemption. And finally, coming in at number 3, pulling money out for a home purchase. Now, I know with the super low interest rates, many people may be tempted to pull money out of that IRA to purchase a home. Now, the key thing to remember is, on average, the stock market yields roughly a 7% rate of return over the past 20 years. And if you look at the past 5 years, it's probably a little bit higher than that. Whereas mortgage interest rates over the past 5 years, at their worst, were just over 4%. So you would actually be better off paying what seems to be a higher interest rate of 4% as opposed to taking money out of your IRA and losing on that 7% rate of return in the stock market. After all, a 4% interest rate on your mortgage is still 3% less than the average rate of return in the stock market. Now, if you live in a high-cost area such as California, this really may be one of the only ways that you can afford to purchase a home, but that's a decision that should not be taken lightly. So now that you know about Roth IRAs, let us know whether you plan to set one up in 2021. Drop us a simple yes or no comment down below. And while you're at it, don't forget to hit the subscribe button and the notification bell. That way you get notified every time we release another video. Until next time, we'll see you down below in the comments.